you reckon the market's bottomed out? So S&P 500 hit 43.26 on the 27th of January. We are up. Oh, it's not much. It's up 4% since then.
So the Russell 5000.
Even the Nasdaq. Nasdaq's up 5% during the bottom. I reckon Bitcoin's front running the bottom here. So Bitcoin bottomed out a week before. And then you've got...
Okay, that's pretty interesting.
22nd of Jan, Bitcoin bottomed out, and then you've got equities bottoming out on the 27th.
Maybe this is just human nature. Do you kind of doubt the rebound at this point?
Well, everyone doubted the rebound in 2020.
Yeah. Something is...
Aussie market's up pretty strong,
I mean,
5%.
How much should rates be knocking markets down? Yeah, how much do you adjust that discount rate for the prospect?
Well, I think no one knows. That's the whole point. That's why everything's just getting crucified.
So the Aussie market's up, what, 2.5% in the last week?
Yeah.
Down 3.6 for the last month.
But from the bottom, 27th of Jan, it's up 5%. Hey, my trade's doing well. All right, welcome everyone to the third episode of the Wide Lens podcast. Hello, Matthew.
Welcome back. How are you, Rob?
Good. Hey, just a reminder before we get into things that you can check out the video of these episodes on YouTube, and it is not under the Wide Lens name. It is under Baharian Wealth Management on YouTube. And so all these charts that we refer to and pop up and headlines, jump on the YouTube channel, and the Wide Lens is the videos are all there, and you can see all the headlines, all the charts, everything that Matt and I are talking about. You'll see there in the video. So jump on YouTube and check out the videos there. If that's not your thing, keep listening to it on Spotify. Apple Podcasts, although YouTube and Google Podcasts has recently been coming up for me saying that it's been this whatever it is been restricted for under 18. I don't know if it works for you, but
I didn't even know.
Okay,
Google
we might have to check that out. But we're supposed to be on Google Podcasts as well, but I think Google thinks that I'm under 18, so it doesn't let me.
Maybe it's some of the language, Rob.
Yes, we might have to cut that down. I've been getting some WhatsApp messages from friends and whatnot, just with some questions. If you guys have got questions, feel free to email us. Probably the best email is our info email address. So info@baharianwealth.com.au. So flick through anything you guys want to have a look at, or for us to have a look into, charts, anything, we'll be absolutely up for it. So let's get into it. We've got a bit to cover again. We scrapped out a whole bunch of things that we would love to have covered, but just don't have time.
Yep.
Interest rates is obviously continues to be making headlines, and it probably will continue to make headlines until March, until the Fed meeting and actually raise rates. I think that's pretty much a guarantee now.
I think we could just leave that there for the rest of the year. Interest rates, it's just
interest rates,
stock standard.
But some of the things we haven't been talking about is probably more in our own backyard with housing and interest rates. So
yep,
let's get straight into it. And Matt, let's talk about Australian property.
Yeah, so Aussie property. I think every Australian's favourite asset class. So there was an article come out in the Fin Review last week, basically reporting some of the 3-month numbers to the end of January 31. So Tim Lawless from CoreLogic, he was out there talking about some of the trends in the data. So what they're comparing to is the October, November, and December 3-month period versus the November, December, January 3-month period. And Tim points out there was a fairly major decline.
Decline in price?
Sorry, decline in the trend. So he said, looking at the long-term trend, it's quite clear that most capital cities are slowing in the rate of growth, even Brisbane and Adelaide. So the 3-month period through to the end of December, Sydney was up 2.7, Melbourne 1.5, but the 3-month period to the end of January, Sydney was 1.8, Melbourne 0.8. So his point there is that it's still growing, but it's growing at a slower rate. But I did enjoy the comment that the October through December period was a record rate. It was the fastest 3-month period of growth that they had seen.
That CoreLogic have seen?
That CoreLogic had seen. But he did make the comment that it is slowing dramatically. So my thoughts were, well, obviously it's got to break a new record to grow faster than the previous record. But anyway, so it's growing at a slower rate. And I think that's probably not surprising. These things don't go up in a straight line fashion. They go up and down, and we may even have a month or two or a quarter or two of negative growth. But it's not to say the property prices are crushing. And I think that was kind of the thing that came out, is that, we're still growing. We might be growing at a slower rate, but we're by no means falling in prices.
So the number of Melbourne, which seems a bit lower, I've just brought the article up, and so what Shane Oliver's saying, Melbourne most exposed, AMP chief economist Shane Oliver said the prospects for interest rate increases would hit every market, but Melbourne would bear the brunt. Melbourne is the most exposed because of the large supply overhang, and it has a more fragile economy given the damage done by multiple long lockdowns. I don't disagree with any of that. I just wonder, though, with announcements being made with international borders reopening on the 21st of February, and I don't have this chart, but I recently had a look at it, which shows buildings completed and immigration, and you see from 1996 immigration just skyrocketing and supply just can't keep up.
Is this Australia generally or Melbourne?
I don't know. I can't remember. Okay. I'd say it's Melbourne. I'm not going to try and bring it up now, but supply couldn't catch up, and then supply caught up just as APRA implemented the prudential measures,
borrowing restrictions. Yep.
And then basically you had construction go down, and then you see 2020 hit. You see migration literally fall off a cliff, and of course we're going to have a supply overhang because we've been building a whole bunch of stuff on the basis that migration will continue. But I reckon migration will pick up. It's going to take a little while, but I don't. Yes, things have obviously changed, but I remember speaking with Scott Keck, who was talking about how people, if anyone's looking to move, barring these snap lockdowns and multiple lockdowns that Victoria has experienced over the last couple of years, Melbourne is an excellent choice to be moving to, where our density is far less than something like a London or a New York. And so people are worried about coronavirus or whatever variant there is on that day, that Melbourne is actually a pretty good place to be at, to be living in and to be migrating to, if people have got choice between the major cities around the world. Yeah,
that's interesting. And I guess prices are relatively lower than Sydney as well, and apparently growing at a slower rate, so maybe even more appealing. One other thing that the article noted is the number of listings less than 30 days, so i.e. a listing that's gone on and has been sold within 30 days. And in Melbourne had dropped by 29.3%. Sydney and Brisbane about a 14%. The largest decline was Canberra at 31.8%. So prices might be growing at a slower rate, but the demand certainly hasn't dropped out there.
And we talked about that last week with inventory when we were looking Australia-wide, and we looked at South Coast New South Wales.
Yep.
Which tells a similar story. Although interesting, like visually, that didn't look like, I don't know if it looked like to you, but visually to me, it didn't look like the 30-day listings were like 2/3 of what they were previously. But I'm sure the data's right. One of the things that I just want to bring up this chart, which is which we've titled Australia's property market, the state of play. And I don't think I've shown you this one, Matt, but the dark blue line is the building approvals. Now, this is Australia nationally. So the dark blue line is building approvals, and you can see the big spikes, early 2000, 2010, and then again 2021 in the dark blue line. And then you see major declines in building approvals. And what you then see, the aqua line, is the dwellings under construction. So once a building gets approved, it then starts construction. And so what you see is a bit of a lag, obviously. Construction follows approvals.
Yep.
And then what you see, this is interesting, is you see prices. This is CoreLogic data. So I've taken the 5 capital city aggregate. But if you have a look during building approvals back in the maybe I think 99 2000, where you've got the first spike in building approvals, you've then got dwelling under construction spike, and then you've got almost at the same time you've got prices spiking, and then they turn. You've got prices, building approvals going up again in 2001, 2002. Dwellings under construction follows. Price peaks somewhere in between dwellings being approved and construction commencing.
Yep.
And then you continue to see that same trend, right? So you look in 2010. I'm just wondering whether when you've got building approvals, you've got builders or developers then selling at a higher price, and then construction coming after. And so to me, it looks like prices are peaking just after building approvals and just before construction commences. And we see the same thing now. So 2021, we saw a peak in building approvals. I think we've seen I think we're going to see a peak in dwellings under construction, and we're probably going to see a peak in prices. We've seen it every single time building approvals jump and construction jumps.
Yeah, it's pretty consistent, and I think you're right. It would appear that prices are levelling, and dwellings under construction is still rising, whereas the approvals have clearly peaked and fallen off quite dramatically. I mean, if you look at the low of the building approvals, what's that, -20? So we're, arguably, we're probably not too far off that low point. If that trend continues.
I don't know. Maybe we're just picking here, but we may have turned a corner in building approvals. You can see it's not going down. it seems to be plateauing. But in 95, 2001, 2009, 2019, once you see these bottoms in approvals, soon after you start to see a bottom in prices. So I don't know how much of that's going to continue to carry on this year and the following, but to me, that seems like a pretty good, consistent guide for... And look, I don't know what the numbers look like for Melbourne and Sydney and so forth, but I suspect it'd be pretty similar given this a national average. I wrote a little bit about this back in July 2021, and I titled it The Bursting of a Property Bubble. And there was so much at the time going on about how much property prices had gone up. And so what I did was I brought up a chart which looked at the bottom of property prices, and that first chart, we'll share the link to the note in the show notes as well. Australian House Price Index. We've got Sydney in June 2020, before things really bottomed out, up 15%. Adelaide up 13%, Brisbane up 13%. National average up 12%, and then Perth up 9% and Melbourne up 7% during that time. And then what I did was I took a much longer viewpoint and stripped it all the way back to 1996. And if you take a point-to-point price change, Melbourne's grown by 435%, Sydney 368%, Adelaide 264%, Brisbane 241%, Perth 178%. And then I annualise them. So Melbourne over that same time has grown just under 7% per annum. Sydney at 6.37, Adelaide 5.3%, Brisbane 5.03 and Perth 4.17% per annum. And so people talk about the outrageous growth in property prices. But when you strip it back down to a annual growth rate, to me, those numbers don't sound ridiculous. And in fact, I went further on and adjusted those numbers for inflation. So I don't know if you've seen this, Matt, but since 1996, Melbourne, adjusted for inflation, has grown by 4.32% per annum.
I did see this.
Oh, did you see? Did you have a look at it?
And I was a bit like, that can't be right, surely. But
no,
I mean,
it's absolutely right. It doesn't include rent. It's just price.
Price.
It's just capital price. Sydney 361. I redid the numbers last night as I was just putting in some additional notes for today. And so these numbers aren't updated. And so Melbourne goes from like an annualised rate of return of 4.32% to like 4.45 or 4.5%.
Yeah, right.
So it's not a massive
pretty
jump over the course of the last 9 months or so. But like, how is this ridiculous? How is Sydney growing at 3.61% per annum off real return?
Yep.
I just don't understand what the issue is.
No, and I think it's one of those cases where we see prices go up. You know, next door sells for, I don't know, 1.2. A couple of years later, you see it sell for 1.4, and you go, oh, 200 grand, that's a lot of money. But in annualized real terms, I mean, I saw these numbers and I had to look a couple of times, thinking it can't be right, because that narrative is property prices are out of control, they're booming, they're this and they're that, housing is unaffordable. And not to say that housing isn't unaffordable, but it's certainly not going up at the rate of knots.
Why do you think housing is unaffordable? Why do we say that?
Well, maybe it's more housing where you would ideally love to live is unaffordable. So, and it's often referred to with new home buyers, first home buyers, trying to get into the market. You know, if you're trying to get in anywhere within, 16 Ks of the city, you're stumping up more than $1 million easily, I would think, which that's a 200K deposit. If you're putting 20% down plus stamp duty, which is probably another 100,000. It's a lot of money relative to wages. I don't know what all that looks like, and maybe we can look at that next week. But that's certainly, it's the narrative, and I've never looked to see just how true it is, and maybe we need to, because equally the narrative is prices are out of control and they're growing at crazy speeds or crazy rates, and not necessarily.
And people were talking about migration and migrants coming and buying properties in Australia and taking away the supply.
Yeah.
Like no one's stepped foot in the country. No one's come off a plane and bought anything. We've got no supply. We've seen prices rise 21%. I think nationally that was the number over the course of the last 12 months. Yep. We're seeing the articles such as these talking about housing market shows fragility despite small gains. It's obviously talking about a slightly different thing, but I feel like it's such fodder when we talk about property prices.
It's just, it's, I don't know, it's like COVID, something to talk about. Everyone kind of starts to agree. All the news is saying the same things. So you begin to believe it. But I think we mentioned that last week that, once foreign investors are able to start coming in, or more migrants are coming in, where do house prices go? I don't know. Maybe that annualized growth rate jumps up.
Or do people who bought that second home or that holiday home or whatever the investment property, do they then sell up? And do you start to see...
Well, why would they be selling up?
Why would they be? Because interest rates are going up?
Yeah,
maybe they can travel. I don't know. There's a whole bunch of reasons. Why did people sell down their Peloton stock? Because they can probably go outside and go for a run now. I don't know.
Yeah.
There's a whole bunch of reasons that I don't think we'll know until we know.
Yeah, no, I think you're right. But it is certainly one that will be really interesting to watch. And that's assuming, of course, that people want to move here. Maybe they're scared off by lockdown after lockdown.
That's a really good point. Western Australia still closed their borders. Victoria's been just an absolute roller coaster. And I know of people, and I'm sure you do as well, and listeners know of people that have put an application in, jumped on a plane, head off somewhere else, moved to Queensland, moved to New South Wales.
Yep.
So this one's one to watch. I don't think property prices, this is my personal opinion, I don't think property prices are, when you crunch the numbers, have grown at a ridiculous rate that is being purported in the market and being reported in the market.
Yep.
I agree with you that property prices are unaffordable because I can't afford to buy a property where I want to live, and I don't want to live in an apartment. I don't want to live in a townhouse, and I want a backyard, and I want this, and I want that. That's unaffordable, and so we blanket that under property becomes unaffordable.
Yeah, no, I think you're right. Interest rates will play a big part in.
I think that'll shake it all out.
Yeah.
Let's move on.
Let's move on to interest rates. The topic of the year.
But hold on. So you called it, right? Is this the button? We have the Oracle.
Thank you.
Mr. Matthew Rigby calling no RBA rate hike. Was that last week?
It was last week. I don't know that that was news. Although I was shocked. You told me after the pod that I think it was Westpac were calling for a 25
yeah,
basis
I think
point
Westpac
rise.
was calling for a rise.
Which I was shocked. Normally, I've always thought...
But you've got to be contrarian, right, maybe?
Well, maybe. I've always thought the chief economist, I can't remember his name now, but I've always thought he's had the inside running with the RBA.
Bill Evans.
He just always seems to nail it. Maybe they're just setting the expectations. I don't know. But anyway, the RBA met last Tuesday.
I could be wrong, man. Like, I'm just reading it now. It says Westpac forecast RBA rate rise by August. And this was written 2 weeks ago. So it may or may not be. I don't know. This thing changes every day. So
we're not accusing Westpac of saying the rates were going to rise, nor are we saying they weren't saying it.
I don't know what we're saying.
So the RBA met last week, didn't raise rates, as expected, announced a pullback or a ceasing of their bond buying program, which I think was fairly well expected. And I think the expectation is they want to wind that down before they do actually raise rates. And, we haven't done this before. We, reserve banks, central banks around the world, haven't done this before. They haven't ended these bond buying programs. We don't know what it's actually going to do. There's plenty of evidence anecdotal evidence and market speculation, but we just haven't done it. So I think, unlike the Fed, who look like they're going to raise rates while still winding down or quantitative tightening, I think the RBA approach is probably better. Get that out of the way, get a clean slate, get a feel for what's really happening, and then start to raise rates.
Because their bond buying program, as a consequence, keeps rates low, and I think it was a 3-year rate they were targeting, right? So if they're
3 and 5, I think it was.
I think so. And so if they reduce that naturally, you'd think allow rates to start rising. Yeah. But I don't know how much they're buying to then make an impact. So I don't know exactly what the numbers are, but that makes sense to me. But I don't think it's a you have to stop that before you can start that. Clearly, the Fed's. It's pretty much guaranteed the Fed's raising rates right in February, in March.
Absolutely. No, you don't have to, but I think in my little brain, I go, all right, get this out of the way. We don't really know how much that's suppressing rates and what are rates going to do once the RBA are not involved in the market. And maybe that's enough, that they don't need to raise rates until 2023 like they've said. Or maybe it's not. So get that out of the way, get a clean slate, get a bit of a feel for what's really going on once you're out of the market, and then you can make an assessment. So that seems to be the way, the path that they're heading down. I think the governor left the door open to a potential rate rise in 2022, although they stressed numerous times it's unlikely, data dependent. Yeah. They want to see inflation sustainably within the 2 to 3% range. And wages growth is the big one. And they've talked about that. That just doesn't seem to be getting as much attention, but they have said they want to see wages growth comfortably and sustainably above 3%. I think we're at 2.5%. So I think we're a little way off rates rising. The language did change. 2024, maybe 23 is no longer kind of what they're saying. It's 2023 with a hint of maybe the end of 2022. Again, I don't think that was surprising, but certainly was the expectation.
But it makes so much sense to be, everyone talks about being data dependent and everyone throws that term out, but it makes so much sense. Like, how does the Reserve Bank or the Federal Reserve have any idea whether they're going to raise interest rates okay, maybe the next month it's pretty easy to predict, but how on earth can you predict that you need to raise rates in November or December back into 20? Seriously, man, how the hell would the Reserve Bank know what the economy is doing, what these key metrics or measures are doing in the economy, for them to even come out there and say, we think rates are going to rise the back end of... Come on, man, who knows?
And so much of the data they get is a month or 2 months old. I mean, it's reasonably old by the time they get it. So they're, you're driving by looking in the rearview mirror. So no, I absolutely agree. It's interesting also in the US, the Fed, some of the members of the Federal Reserve. So if you're not aware, there's the Federal Reserve, and then there are regional Federal Reserve banks around the country. Kansas City, San Francisco are two of them, and their respective presidents, governors have been coming out saying unexpected adjustments are in nobody's interest. There will be gradual tightening, and the need for moves are also data dependent. So there seems to be a little bit of a split in the US. I think I referenced last week that the Atlanta chair, he had come out and said 50 to 75 basis points, he'd be comfortable with that as the first move. Now you've got other presidents coming out saying, well, we need to kind of slow this down a little bit. So there's a lot of uncertainty, and that's what's roiling markets up at the moment. Is nobody knows. There's no clear direction, and we'll know when we get there.
So we've been in a bull market and if you strip out COVID and the pandemic, which literally, how long did it last, man? 1 month?
A week, a month,
right?
Month and a half at most.
And so if you strip that out, we've had some bumps along the way, but we've been in a pretty strong bull market since the GFC. It is
12 years, 13 years.
Yeah, something like that. Yeah. How far, depending on your point of view, if you agree with that statement or not, will then depend on what your answer to this question is. How far into the growth cycle do you think we are? So many people talking about, we're in the eighth innings now, we're in the sixth innings, or we're in the fourth quarter now of this growth cycle. What's your point of view? Where do we sit in the growth cycle?
I love the innings analogy because they can just keep going. There is no end. Look, I'll get out my checklist and I'll have a look. But look, I think I referenced last week or maybe the week before that I didn't really see the COVID crash as a real recession. And the reason being there is it happened so fast, it recovered so quickly. The Fed and Reserve Bank and governments came in with so much money, rates dropped, that excesses weren't washed out. I won't say nobody really felt the pain, but the vast majority of people didn't really feel the pain of what we went through.
I think a lot of people felt the pain, but I think what mattered to the stock market didn't feel the pain.
Yeah, I mean, I think the unemployment rate spiked, but only for a really short period of time. If you go back to historically and look at recessions, unemployment rates spike and they stay there. Or they're really stubborn before they come down. We haven't had that.
Yeah, that's right. Yeah. And I think a lot of that had to do with migration. And people not being able to come in here. And you talk to cafe owners, hospitality is the biggest one, man. People don't even know whether they're going to open their doors up. Can you imagine running a business and you've got no idea whether you have staff for the next day or whether you're going to open?
Yep. Or if you're shutting at 5 or 7 or 3 it's no way to run a business. And then, what do customers do? They become accustomed to not knowing. So
Correct.
do they just stop going there? So getting back to your question, how far in are we? I'm going to say a long way in. How far are we from the top? I got no idea. But the recession call in our bold predictions for 2022, although I pushed it out to 2024.
Can you say 23, 24?
24, 25. Maybe we need to go back to the
Man,
tape.
every week you're pushing it another year.
No, I think it was, I'm sure it was 24, 25. Anyway, I think we're only at the beginning of the rate rise cycle. I think rates, as we said
obviously, but in the growth cycle, you're saying that we're well and truly. Are we in the third quarter or the fourth quarter? Because in quarters they end. Maybe there's a bit of overtime, but they don't go on forever. There's a penalty shootout and someone wins. And so are we in the third or fourth quarter here?
We've got to be in the fourth quarter, surely. as rates start to rise, the end is getting closer. While rates stay at zero, I think this thing could go forever.
So can central banks around the world, and I don't disagree with you actually. I also think we're past half time. We're in the back end of the third quarter.
Legs are tired.
Or we're
stumbling.
Or we're in the fourth. But central banks going so aggressively this late, and that's maybe why people are saying the Fed is behind the eight ball. They're behind the curve, right? That's what I think. That's what the references are being made to.
Yep.
How appropriate is it for central banks to be raising rates so aggressively? I don't disagree with a 25, 50, but going 100, 125, 150, raising at every meeting, like I just wonder how dangerous that is. And I think that's what blows everything up.
Yeah, no, I agree. And I've been thinking about what are the Fed in particular going to do? And what's better? I mean, do you raise consistently? It takes a month or two for that rate rise to really wash through the economy to have any impact. So you're better off going hard early, a 50, maybe a 75 basis point, and then waiting 4 or 5 months to see what the impact really is. Or do you go consistently? I would agree. I can't imagine you'd want to raise 1.5 points.
Well, because that's the thing that blows you up.
It is. I mean, and as we've talked about, debt levels are so much higher. And in the US, it's a bit different, fixed interest rates, all the rest of it. But 1.5% this year would seem a lot. I'd be shocked. Honestly, I think we'd really see the impact of that.
If we had 150 points of rate
150 points, 1.5% of rate rises this year, it's going to have the desired effect. It's going to cool the economy. Does it cool it to recession? That would be the question. And then what do they do next year? Do they start to bring rates down? Does it look like they don't know what they're doing if they're going up and down year by year? I think it was Ben Bernanke that said 90% of central banking is talk and 10% is action. They've certainly been doing the talk. Let's see where the action is.
I put this chart together, which shows bond flows, historical weekly bond flow for the US ETF and mutual funds.
Wow.
And so this, I don't know I think I ran this from the beginning of 2020, and you can see during COVID, all the outflows on the far left is just a massive trough. And we really haven't seen anything until now. I mean, it's very small relative to what we saw during 2020, but we haven't seen anything like that for a long time.
No.
And so we're seeing, 12 million, 12 billion? I don't even know what the number is now. I've got my decimal places and multipliers all over the place. But I think it's 12 million a week of outflow.
That's not much.
It could be billion. Could be billion.
I mean, the bond market's massive compared to the equity market.
No. It's millions weekly.
Yeah, okay.
It's millions weekly. And so the thing that I'm just curious about is this not a risk? If you start to have, I mean, this is weekly, man. Like, it's not like it's monthly or yearly. But if you've got outflows that we haven't seen before, and it's starting to, I mean, it could be a little hairline crack at the moment.
Yep.
But I'm just wondering if we're starting to see these outflows, isn't that naturally going to push up interest rates? If you've got investors selling, this is ETF and mutual funds, and then if you've got the Federal Reserve with their bond buying program taking the foot off the gas, they're not hitting the brakes; they're taking the foot off the gas right now.
Yep. Yeah.
I mean, I just wonder how much of the work is the market doing for central banks with where capital is starting to be allocated to, and with what the central banks are talking about, it's already being reflected in the market, and I feel like the market's doing a lot of the work for central banks.
Yeah.
We talked last week about the Federal Reserve's not lack of interest, but the fact that they didn't really...
Lack of care
for probably riskier assets in the stock market. I don't think they're ignoring the stock market. I don't think any central bank can completely ignore the stock market. But I wonder then if you start having sell-offs in certain parts of the market, but also the bond market, because the thing that we haven't talked about or looked at is credit markets, credit spreads that are not doing anything.
Yep.
And so they've been trading quite normally, relatively speaking, as we've seen over the last few years. Forget COVID. And so if we start to see disruption there and then credit spreads start to blow out, I think that could be problematic. And I think also for the reasons we've talked about in the past, and for that reason, I just can't see how central banks can raise rates as aggressively as people are reporting and as they may have done in previous fast rate hike cycles. What do you think about that?
No, I think you're spot on. I think this all goes back to unprecedented, efforts by central banks during the COVID crash, and how do we get out of it? And again, I just don't know that anyone really knows. I mean, as I said, people have got theories, but if we continue to see money flow out of the bond market, as the Fed are no longer, pumping money into the bond market to suppress yields, then you could see a big spike. And what does that do to investors? What does that do to the share market? What does it do to real rates? Because this is where banks are borrowing from to, provide to us as home buyers. So it could be nasty if it isn't managed appropriately.
Do you think this is a fast rate rise cycle, tightening cycle?
Fast in terms of the number and or duration?
And the pace of rate hikes? Or do you think it's a slow cycle?
I'd like to think it's slow. And I say that just on the back of the winding down of bond purchases. I think the market's expecting it to be fast. And certainly the talk
appears fast, right?
Could be fast, yeah. And again, maybe we're completely wrong. Maybe the economy is much healthier than we expect. The fundamentals of the US economy seem pretty good. Of the Australian economy seem pretty good, but Europe, they don't.
European rates, I don't know if you saw the note from Jim Reid this morning, European rates look like they're going positive at the end of this year.
Yeah.
So it was supposed to be the estimated time frame was 2030, I think, for European rates to go positive, and it's happening in like a matter of months,
few months,
rather than years. Just bring up this chart, which I came across from Mr. Blonde Macro, is the average S&P 500 performance during Fed tightening cycles, and the blue line shows slow cycles. And that's what I was asking you. Do you reckon this is slow or fast? The fast cycles you can see in 68, 73, 80, 87, 94, non-cycles, and then the average. And on the bottom, it shows the number of days around first Fed tightening. And so with the orange one, you can see minus 250 days leading up to the day, and then days after. Even under the first rate rise, markets still continue to go up. And maybe, can you see where it's like halfway, 3/4 way before it hits the x-axis? You've got a dip in the orange line. I wonder if that's when you've got talk of fast rate hikes, like we need to go 100 basis points, we're going to do it quick. The market adjusts, then realises, no, actually this is okay, and the market continues to rise from there. It actually happens, not much happens. I don't know why it drops off like 110 trading days later. I've got no idea, but maybe that's got nothing to do with the interest rate hikes. Maybe it does.
Maybe that's the third rate rise in the cycle. Who knows? This is really interesting. I hadn't seen this, but I think it goes to the evidence previously that the first part of the rate rise cycle isn't the bad part for the markets or equity markets. It's later on, and if they go too hard, too fast. But the slow cycle, is not too dissimilar to non-cycle.
Interestingly, we were talking last week that Bitcoin is not an inflation hedge. And what we saw in Bitcoin price during 2020 like it crashed and then it recovered really quickly.
Yep.
And then risky assets started to recover again.
Yes.
Bitcoin just out of interest when it bottomed out, I think on the 24th of January. I'll just bring that up now. Yeah, 22nd of January, it's up almost 30%.
Is that right? Yeah. Gee.
And so I just wonder if actually like there's some foresight there that and look, equity markets, I mean, it's pretty scattered, right? Like Amazon came out, they got hammered pre-earnings in overnight markets. They were up, I can't remember how much. But I feel like it's a bit scattered at the moment with earnings. I think everyone's pricing in a pretty shitty earnings report.
Yes.
And then if you get a half decent report, the stock rallies in after hours.
Yeah.
And I don't know, maybe Bitcoin's bottoming out here, and maybe there's an indication there for risky assets. I don't know.
Look out, 100,000, Rob.
Oh, that was my prediction, wasn't it?
That was yours. Yeah. Look, I hadn't seen. I was actually wondering how Bitcoin and cryptos generally have responded to the market. I'll call it recovery, stabilization, if anything. Yeah, that's a big move. As the Fed starts to raise rates, it'll be interesting to see how assets like cryptos and NFTs and all the rest of it start to price themselves. The week before, we talked about market concentration and the top US stocks and how much of a proportion that they make up of equities, yep.
and why the narrative is that that's a bad thing for markets. Goldman Sachs had this chart here. Equity market leadership is difficult to maintain. 5 largest stocks in 2000 comprise only 8% of S&P 500 equity cap today. So those companies make up of 8% of what the market cap is today of the S&P. Yep. Of the S&P 500. Okay. And if you look at the 5 largest stocks in 2000, at that time they were making up 18%. This time around, it clicked up at its peak in 2020, 2021 at 25%. It's dropped since then, come back a little bit. Now, what we were talking about was at the time was when stocks hit that top 10, the future returns start to diminish. Now, Goldman Sachs had this chart which looks at actually, let's just bring this chart up first. Market cap weight of top 5 stocks in the S&P 500. The weight of the top 5 stocks is near its highest level in the last 45 years, which is very similar to what we just looked at. What Goldman Sachs then did was had a look at when the stock market concentration is this high, what is the forward earnings outlook historically?
Okay.
And so what they then find is there is a correlation of 0. There's an R-squared stat of 0%. And so what that means is market concentration and stocks making up such a high proportion of indexes has no statistical significance. Having said that, it's on forward 1 year S&P 500 returns. Interestingly, the numbers that we looked at out of the dimensional piece had like a 10%, 10-year annualized rate of return of negative 1.5% from memory, or 1.79%
relative to the market.
Relative to the market.
Yeah.
And so what Goldman Sachs is saying is that there's no statistical significance when you have companies making such a large portion of the index. And just for some context, the 20 smallest companies in the S&P 500 are each worth less than $10 billion. And so when you've got Apple 2.8 trillion, Amazon 1.6 trillion, Microsoft 2.3, Google 1.9, and Meta or Facebook 650. Do you call them Meta? Do you call them Facebook?
I don't know.
Is
that post there?
That's post. So they were sitting at 850 billion, and so that's after the clobbering. And so had a look at trying to bring up some stats on what the historical companies and what proportion that made up. So AT&T, I didn't know this, was 13% of the total US stock market back in 1932. General Motors was 8%, IBM 7% in 1970. And so if we look at that, right, so if the S&P 500 is at 40 trillion, so what's Apple as a proportion?
Were they nearly...
So that's 7.5%. So the biggest company right now, the biggest individual company, is 7.5% let tops. I've rounded Apple up to $3 trillion, right?
Yeah. So similar to IBM back in 1970, GM.
1970, right?
Back in
GM in 1928, AT&T. But see, the thing is that if you look back at what AT&T was doing and what IBM were doing back in the early 30s and in 1970, and General Motors back then, and even General Motors today, really, like these companies, I feel like are almost more one-dimensional. Whereas if you look at Apple now, we'll talk a little bit about that. If you look at Apple now, if you look at Amazon now, if you look at Google now, these companies have companies within companies. Mm-hmm. And I don't know, my guess is though that the companies that were the biggest companies back in the 30s and 40s and 50s, all the way up through to maybe even 2010, did not have those characteristics whereby they were sort of a bit of, I won't say a one-show pony, but they certainly did not have the diversity and the integration that some of these companies have today. And so if we look at, I just got Microsoft's numbers here from their earnings. And so if we look at this, they've got 10 businesses within that one business. And these companies within Microsoft, so you've got personal computing, $17 billion, cloud, $18 billion, revenue, productivity, business processes.
More personal computing.
You've got, I mean...
What a division. They're huge.
And so people talk about if Amazon were to strip out AWS.
Yes.
That's a $18 billion revenue company. And I think it's actually web services that is holding up Amazon's revenue, certainly over the last quarter.
Yes.
It was, and it may be even over the last year. But you've got advertising on Amazon, $9.7 billion on their latest earnings, online stores, $66 billion. I mean, that looks like a monster, but it's loss-making. Super low margin. And, you know, they obviously came out with Prime and overnight and all of the logistics and whatnot that comes along with getting products to you. It's almost like so many other companies have caught up. They've now set that benchmark, and I don't know if they've got any edge over any other company now to get product to you. So I feel like naturally they're going to have to go into different areas to start becoming the market leader in that. And then you've got subscription at $8 billion, which, you know, it's a big enough business in of itself, but it's, you know, it's certainly not the thing that makes or breaks.
No, but it
Amazon.
also supports so much. You know, supports their advertising business, supports their online business. You know, the Amazon Prime subscription, you get next hour, 2-hour delivery in some of the major cities in the States. So they're all connected.
This thing. So Standard Oil, when it got broken up and, you know, it became all of the oil companies that we know today. I mean, is that the worst case scenario for the likes of Microsoft or Google, whereby their companies are broken up? And so what does that mean for shareholders though? Like, you end up with stock of something else, or you end up with stock of another company that's bought this thing. Like if that's the worst case scenario, I just can't see why that's such a big deal. The only thing that comes to my mind is you end up losing the economies of scale and that vertical integration.
Yeah.
I don't know how much of an impact that has, but I mean, the point that I'm trying to make is I don't know how much we can compare the market concentration today versus the market concentration of even 15, 20 years ago, because again, I feel like they were far more one-dimensional than what the companies are today. What do you think?
I mean, they're the modern day industrial conglomerates is one way of looking at it. And you think, you know, Alphabet or Google, they've obviously got YouTube, they've got the Google search engine, which both of them are just massive. I mean, the search engine's just such an enormous cash generator for them. They've got a Amazon Web Services similar type business, a cloud hosting business. Mm-hmm. You look at Apple, I mean, they've got all sorts of products, but it's their services division that's growing, and that's such a backbone for them. It just generates tons of cash. They've got that ecosystem, and it's quite effective. So No, I agree that they are not similar. I wasn't around in the 30s, despite what my kids would think. So I don't know how dominant ATT was in multiple asset class or multiple industries, but I would say it was just phone lines. You know, there were no mobiles, there's no internet, so it's just cables between houses and connecting people. There's been a lot of talk about breaking a company. Remember Microsoft back in the 90s? Remember they went through the antitrust and they were going to break up Microsoft because they were so big and nothing ever happened. And look at them now, second biggest company in the US and second biggest listed company in the world. So, look, I think it's a lot of talk. I think it's probably not going to happen. Interesting that despite all Congress's jawboning about Facebook and privacy and all of this, it is Apple that's actually had more of an impact on Facebook and their privacy through their the option to not track users, I think it is. So that's been way more effective.
I just assume everyone tracks me anyway, so I don't even...
Well, it's been way more effective than anything Congress could do. So, maybe Congress should flick some dollars to Apple and say thank you. But look, I don't think any of these will get broken up. The US is such a capitalist society. I'd be surprised. But, I guess could be good for businesses. It could be good for shareholders. I mean, if you've got Jeff Bezos, not that he's there anymore, but, the management team focused on just one division.
You looked at that company. Like, I forgot that they acquired, Whole Foods. Yes. I can't remember the newspaper.
The
Washington Post. I was just reading what the company actually owns, and it is insane.
Yeah, it is crazy. I mean, you think about Microsoft buying LinkedIn.
Yeah, I remember that.
I can't remember who owns Fitbit now. I have it's not Microsoft, but I mean, they've just got so much money. But anyway, what I was going to say is, if you've got management purely focused on YouTube, maybe that growth of YouTube.
But of course they do. They've got a management team that manages YouTube. It's not like
just YouTube. So maybe it's good for shareholders in the long run. I personally like the larger businesses because you've got, say, Google's other bets. You've got a big search engine funding other programs
100%.
that could, be like Waymo, their self-driving division. I think that would never have happened if it was standalone.
And Amazon, I'm sure you've seen where Amazon come out. Remember they had a phone and they ditched it, didn't work.
Yep.
Like I don't think
Fire, is that what it was?
Yeah, that's right. I don't think you can have that type of exploration if you don't have any money, right? And so when you've got a big conglomerate, there are certain parts of the business that are helping fund other aspects of the business. Yep. That gives you an opportunity to explore, be curious, take a risk. If it doesn't work out, we've seen how many times Amazon, you see letters that Jeff Bezos have sent to employees. Like that's really cool. It gives you that real entrepreneurial spirit to be able to try and innovate and grow and whatever the case may be.
Yeah.
But I don't know how much you can do that if you're just running that one company and you're solely focused on that.
Another company that's really good at that as a side issue is 3M. So they have a division where they are just trying new things. They encourage employees once a year, twice a year, whatever it is, just try something new. Try and come up with something new.
To hold up a painting that's 40 kilos?
As opposed to 38. So it's. I think you're right. I think big companies can do that, and their next future leaders are born out of that.
Yeah, I agree. Let's move on to investor panic. Sentiment Trader had this chart which looked at the number of option trades. So they're called small options. So those options that are less than 10 contracts, and it's showing a record level of panic. And so price action in last 2 years. So look at this chart. The top bar is small trader contracts buying put options in millions. So nearly 12 million put options bought during, when is this? Even, I think this was last week or the week before. And the bottom area of the chart showing small trader premiums spent. So how much people are spending on put options to protect them from their stock falling even further.
Yep.
And so generally you start to see this level of activity when people are becoming fearful and trying to protect their downside in their stock holdings.
Yep.
They start to buy put options. And the thing that I looked at this is, and that's all good and well, but when this chart goes back to 2000 and you can see it hitting COVID in 2020. And then all of a sudden there's just this hyper activity in options trading. And these are small contracts. It states here that less than 10 contracts. I'm just wondering how much of this has to do with small investors coming in, gambling without having anything to do during the pandemic. And we saw it in the meme stocks.
Yep.
And now that shit has hit the fan, everyone's trying to protect their positions. I also just think about, is this a telltale sign for things having bottomed out, and are things going to get better from here? It's like someone, and for listeners, it's like your house burns down and then you call the insurance company and say, hey, I want to take out insurance on my house. The whole point is you've got to do it before your house burns down. And I feel like for those reasons, I feel like I don't know how much there is to look into this, but we're starting to see more premiums being paid, more put options being bought, which I was surprised at this, higher than what we saw during COVID.
Yeah, that's surprising.
That's
as well,
the thing.
That peak, it's not just a little higher; it's significantly higher. And whether that's because premiums are higher, but the top part of that chart there is contracts. There are
number
more
of contracts.
people, number
Correct.
of contracts. So it's probably a combination of both. But
do you think this is a new normal where you've got more participants in the stock market than we had before, and naturally they're going to start doing these
Possibly.
types of things?
Yeah, I mean, I don't think it's a bad thing either. I think
It's a valuable lesson for people.
It could well be, and it is quite funny that the market falls and then you go and protect. So I guess one way of looking at it is it's good that they're not selling. They're not panicking, selling out. They're staying in the market. They understand that volatility is.
Well, we don't know that because we don't know what options are on the other side of this. So this is just looking at one side of the trade.
Well, let's just assume. But maybe it's people staying in. It does fit with past downturns in terms of smaller investors get out, panic, get out, stay out. The market bottoms, it rises, and then they get back in. 3 years later and 150% up later, and then they get in, ride it to the top, over the top, down the bottom, and then off they go.
How long do you think that takes for someone to have that muscle memory, like your golf swing, right? And so if you haven't never experienced these types of downturns and you've just jumped in the market and all you saw during 2020, 2021 was these ludicrous gains. I think I was reading Tesla was up like almost 800%. And then it rose 50% again the year after.
Yep.
And that's all you've seen.
It takes a while. I mean, it's even uncomfortable. I've been investing since I was, 16. I think I bought my first shares. And it's uncomfortable. It's unnerving. You go, my portfolio was worth X and now it's 10, 20% below. That's the human nature, and then it's that learned, all those experiences that get you through and go, all right, well, we know you look at any stock market chart over any decent period of time, 10, 15, 20 years, it's going up. That for sure. It's just about.
But you can't see
nerve.
The forest for the trees, right?
And the news is like share market's falling, crash. The news is all red and arrows down and all the rest of it, and it freaks people out. Then you pick up the newspaper, it's the same thing. So I get that, but it's those that make really good money hold their nerve, buy. They have cash, they buy when things are low, they ride out that volatility, and it ends up being a great buy. And we've got clients that bought towards or at the bottom of the COVID crash. They've made fantastic gains. They held their nerve, they trusted the process, they've held on, and they've been rewarded for that.
I don't think we can have this episode and not talk about Facebook's $251 billion biggest
epic
wipeout in history. I think everyone's seen it, everyone's read about it. Do you know what doesn't get talked about though is the fact that we've got these $1 trillion companies. If you're going to take those gains and have $3 trillion companies, like, don't take this exactly the way I say, but who gives a shit about a $250 billion loss? That's totally exaggerating. Of course, it's going to be the biggest loss in one-day history when you've got companies that have never been valued at $2.8 trillion.
Yeah, I mean, for what are they? Meta? It was particularly noticeable given that it was 26% odd. But you're absolutely right. I remember, it might have been the taper tantrum when I was in the US, and I remember, they were talking about the Dow Jones has fallen the most ever. Like, yeah, but in percentage terms, I think it wasn't even in the top 25 days of down because the index was just so high relative to previous index levels. So same sort of thing here, but it is spectacular. When you've got Pepsi at 242
Just get this chart up,
billion, actually. That's crazy.
So, yeah, you're right. Pepsi at 242 billion, Netflix at 1.9 billion. I think the stat was that Facebook lost 1.3 Bezoses in a day.
What a great gauge.
So maybe the Bezoses becomes like this index. But yeah, look, I mean, Adobe, it lost, the equivalent of the entire market cap of Adobe, Intel, and I'm sure there's a whole bunch of others that you can bundle up in this. And the other chart I want to bring up is Bloomberg had this chart, big stock, big misery. But the thing that I took out of this biggest one-day drop in market history, yes, it's the biggest. Naturally, you expect it to be the biggest. But if you look at, I totally forgot about these. Apple, decline in market, 2020, lost $180 billion. I can't even remember what the hell happened 2 years ago that saw Apple drop $180 billion.
I mean, that was at the end of that. The market was well in recovery mode during that period. So
yeah, I can't remember what happened. Tesla's there, Amazon is there. I remember the Tesla falling. I can't remember the exact reason why it fell. Amazon's there, Facebook's there again twice. They've made a couple of appearances now. They have changed the name, so it looks like they've only been there once. But I also feel like you can't have those enormous gains without the volatility. And so I always use Amazon as like the prime textbook example of this. Amazon's share price in the early 2000s over a couple of, I think it was 2000 to 2002, fell 90%. Their revenue doubled during that time, but they got caught up in everything that was going on, and people just marked a different valuation and different multiple on the stock, and it was valued 90% less.
I think they got down to $6.
I can't remember what they got
down
to.
Around that price. You're absolutely right. The bigger the number,
you're right.
Bigger the number.
Yeah, so I can see $10 on this chart. Maybe the area is too small. So I think that was really interesting. What I've been reading is that the issue for Mark Zuckerberg and for Meta now is that employee shares vest on February the 15th. So bonuses, promos happen in March, and so it'll be really interesting to see what happens leading up to when you've got stock vesting, what executives do with their stock.
Yep.
And yeah, I don't know how much more we need to talk about Facebook or Meta. I think it's been well covered. Interestingly, I did read a post-mortem by Barry Ritholtz, which he titled Faceplant. And it was really interesting. So some of his thoughts were Meta being ad dependent. Google's ad revenue is down 81% of the company's total, down to 81%. Facebook it's 97% of ad revenue. What you talked about with Apple and privacy, and obviously they've got, do they call them subscribers, active users, whatever they call them, has turned for the first time in however many years. We haven't, albeit it's like this hairline turn.
Marginal. I mean, there's still 2-3 billion users, whatever the number
is.
Enormous.
Competition, TikTok, I think their CFO cited and referenced TikTok a number of times in the quarterly. We talked about Apple's privacy. Barry talks about the concept being dated. And interestingly, you and I were talking about this. When you look at something like a Facebook and you contrast that to this post-mortem, it's easier to look at it and go, yeah, it actually is pretty dated. But if this didn't happen, I wonder if anyone would observe that Facebook would be a dated platform. I don't know. I just found this really really interesting. Again, I don't think we need to talk too much more about that. Do you have anything to add to that one?
Not really. There's probably a lot more volatility to come. I think they've got to get the market's confidence back, and I don't know that we're going to see many more 26% declines. But it's in keeping with what's been happening, though, and maybe this goes to that smaller investor panicking. Some of the swings have been amazing. Snap was down 23% last Thursday. And then up 54% after hours. Now, after hours trading's thinner trade, it's a bit more volatile, but they were still up strong on Friday. Pinterest was down 10, up 18, and Amazon down 7, up 14 after hours. I mean, we saw it with Google, we saw it with Apple. So I think there's a lot of skepticism about earnings, which is leading to market volatility. But if a company comes out with half-decent earnings, shows a bit of pricing power or whatever it happens to be, that the price is going skyrocket.
I feel like the market is pricing in for the worst and then waiting for results to come in to prove me wrong or prove me right, and then we'll get back in.
As opposed to the last couple of years where it's pricing in, we're expecting really good.
Yeah, you're just front-running earnings. Yeah,
and
100%.
Yep.
100%.
Yeah.
Anything else we want to cover here, or
I think we've covered that one. I'm sure we'll come back to Facebook/Meta at some point.
I mean, the other thing is that I think they clicked like $100 billion in revenue. And that was a thing that I didn't see that much on in the headlines. You just saw the wipeout. But it was for the first time they cracked that revenue number. Yeah. Which I thought was interesting.
Yeah, but earnings were well below. I think they missed earnings by 14 cents.
Right, okay.
But, they're still growing and they're growing dollars per user as well. So we'll watch that. That'll drive the stock.
Let's wrap up with tips and recommendations. What do you got for us?
All right, so this past weekend, we went to Funfields, which, for those of you who aren't aware, it's a water / I'll use amusement very loosely.
Where is that?
It's a fun park. I don't know, north of the city. It took us about, 45 minutes to get there. Felt like forever.
Whittlesea.
Is that where it is?
Yeah, that's where it is. What Google says where it is.
Okay. That's where it is. So look, I was a bit like, this is going to be boring. Kids are not going to love it.
Look at the website. How can you say this is going to be boring?
They loved it. It was a great time.
I haven't been there in like 25 years.
Yeah, so I'd never been there.
Oh, you've never been there at all?
No, never. And I was really surprised, and it struck me just how clean the park was. I mean, it was spotless. There was no rubbish anywhere.
Because no one's been there for 2 years.
I'm sure there was someone there the previous weekend. But, even on the day, there were people everywhere. The place was packed, and it was still really quite clean.
How much were tickets?
I think it was like 55 if you're over 130 centimetres and between 100
that's
15 or something.
48.
Yeah, 48, so a little cheaper. But the wave pool was pretty cool, although the wave pool, the waves coming from the back of the pool was about the same size of the number of people flooding into the pool as the wave started. It just got absolutely packed. So I'm out there, and 1.6 metres of water, trying to surround my daughter so she didn't get drowned by all these people in there.
The boys love it?
She's only little. The boys loved it, had a great time. Went on a few, water slides. It was good fun. Some non-water rides as well. Something that goes upside down, which one of my boys absolutely loved. Some pirate ship, which I think is similar to the one at Luna Park. But anyway, kids had a great day. It was 5 or 6 hours well spent.
Is the wave pool the volcano beach?
Yeah, I think that might be it. Yeah,
there's
no sand though. Which is good.
I totally forgot about Funfields.
Yeah,
I've been there like 25 years ago, but it looks pretty cool with what they've got.
I've never heard anyone talk about it. I didn't grow up in Melbourne.
So how'd you find out about it?
So it was our daughter's birthday. So she was just like, I want to go to a water park. I'm like, there's one in Geelong. Is there one closer? It turns out there is. So it was a really good time. Pretty reasonable. The lines for the food were probably the longest line of all the rides.
Is there a fast pass? Can you get fast passes?
You can.
Wow.
And so there's...
awesome.
You can use it once. So, I don't know, it's $20 or something. There are 5 rides that you can use
they're
it
the
on.
only rides you can use fast
only
pass.
use it once for that ride per fast park. So it's not like your Disneyland fast park.
Yeah.
Which is hard to explain to the kids. Like, why can't we? Like, no, it's just not worth it. But the lines, I think, for all barring one ride, they were within half an hour thereabouts. So it was pretty reasonable. Busy day, hot day. Kids had a great time. So it was.
Do you remember
pleasantly surprised
during COVID when no one was ever going to go to a theme park again, and no one was ever going to go on an airplane again?
Yeah. It was so nice to be normal. Like it was so nice, and not have to wear a mask.
Are people worried? Like, were people like distancing and?
No, I gave a shit. So we're at the wave park, Volcano Beach, whatever it's called. So we had our stuff. We managed to get a lounge. Had our stuff on a lounge, all our towels, and there was some bloke, like literally, he was almost leaning up against it, just sitting under the shade. He was not concerned about social distancing. Did not matter to this bloke. But look, I think generally people were pretty respectful. Didn't really see anyone kind of lose it. As I said, it was hot. There were lines. If you do go, I'll give you one tip. Don't go to the main food hall. It was like the line there was at least an hour. Some of the like Volcano Beach had a
Don't you bring
food
your own
area.
food to places like this?
Yeah, but some areas don't allow you to bring food in.
Right. Can't you just say that you're, I don't know, celiac and you can't have gluten, so you have to bring your own food?
Yeah, maybe. I didn't think about that. There were people there. I swear there were people that go every day because they were fully kitted out.
They know what's going on.
The trolley with multiple bloody cartons on it and the tents and So no, it was a good time. Had a good time.
So
What do you got?
two things. We were talking before we started recording this about Elon Musk, Tesla, and what's
the Optimus humanoid robot
Optimus
thing.
humanoid that they're creating?
Maybe we'll talk next week about that.
And so the Optimus humanoid revenue is going to be up more than car sales.
cars.
What's the humanoid supposed to do?
Carry heavy things. I think I worked out like it can carry. I think up to 20 kilos. Be like, that's not much. What's the point? I think he just likes it. I think he's going to take them to Mars with him and let them cruise around Mars and dig for stuff.
So what is it supposed to do stuff for you? Like, can I talk to it and it will go and I don't know, pick up this drink bottle and then what's it going to do with it?
Bring it to you?
I don't know.
I don't know, man. I think at the moment it's more about repetitive tasks in a factory.
Oh, okay.
More
so pick up
supplies,
this box,
labour shortages, that sort of stuff. But I think, it's not a big
see.
leap from that to having, what was the robot's name out of the Jetsons? Whatever her name is. Like, it's not a big leap to get there. So you've got a robot in your house. Is that what you're about to tell us?
Rosie the robot.
Rosie, that's it. Yeah.
Yeah, it's funny. Like, you look back at like the Flintstones and the Jetsons and how futuristic that's supposed to be. Don't you think we're kind of living in that now, where you've got autonomous? So I've seen videos of people jumping in autonomous taxis in San Francisco, and this thing. So there's two guys. One guy's recording what's going on. He's recording him and the steering wheel, and it is. I would jump in one. That would be so fun.
More fun than a roller coaster at Disneyland.
I feel sick in roller coasters. And the reason why I'm asking is because I watched Mother Android on Netflix. I don't know if you've seen this.
No, I haven't.
Mother Android, and I've stopped looking at Rotten Tomatoes reviews because, I don't know, I just feel like all these other people's opinions start clouding my judgment on whether I'm going to watch this movie or not.
Yeah.
But Mother Android is this movie about android robots that are butlers and servants. Not servants, that's not the right word.
Are they serving people?
Yeah, they are. They're like housekeepers. So, everyone's got one.
Yeah, okay.
And so they're android devices, but they're humans. And it's like T1000.
Like they look like humans?
Yeah, they look like humans. And so beneath the skin, they don't have any blood or anything. I can't remember. But beneath the skin's all robot.
Okay.
And so these people cook for these families. They clean. They're like a butler service.
Yeah.
They're like every house has got one.
Okay.
And cut a long story short, and I don't know if you want to watch it, I'm not going to spoil it for you, but I kind of, if anyone's going to watch it, maybe just stop listening. But
come back next week.
These robots go crazy. So there's this malfunction. They work out how to override the human program that's programmed for them to do certain things and not do certain things.
Right.
And so I'll yell out, I don't know, this code, and then it shuts down, and it's like an override code. But they work it out, and so then they basically start killing all the humans and taking over, and it's about the human race getting together with different groups, setting up camps all over the world in pursuit of trying to kill these robots. It kind of reminded me of, remember Will Smith's I Am Legend?
Yeah,
where you had these, what were they? Were they zombies?
Zombies, yeah.
They would only come out at night time.
Yes.
And they're, you know, in that room where Will Smith goes in because his dog
goes in, yeah.
And they're all just like panting around in the corner of this dark room. It does get a bit creepy like that in some parts. We watched the whole thing. Would I watch it again? Definitely wouldn't watch it again. Get nothing to do. So it's kind of like a non-recommendation.
Oh.
We on the weekend and
out of 5, what are we giving it?
I think Deb and I.
IMDb's 4.8 out of 10. So
I just looked it up. Rotten Tomatoes got 32% on it.
Yeah.
The way I think about things is, was it average, above average, below average? I'd say the best rating I'd give it is average. So 5 out of 10.
All right.
Check it out. In the end, though, there is a bit of a twist at the end, and that's probably the best part of the whole movie. But you got to sit through like 2 hours to get like 3 minutes of good part. Actually, toward the tail end's a bit of a twist. You did Fun Fields. We went complete opposite. I sent you a photo on WhatsApp. We went to, is it Time Zone at Crown, a Kingpin?
Oh, okay.
Kingpin at Crown. And man, I haven't been there in years, but the sophistication of these new arcade games is insane. They are so good. They are so advanced. So having come from, I don't know if anyone listening has been to Merimbula, and if you've been to Top Fun, those machines are like
the old pennies where you...
Yeah, I used to go to Top Fun and put like 20 cents in a game, and some games are 40 cents, and they're like a rip-off.
Yeah, that was a long time ago.
And so they've actually got like old games from like the 80s and 90s at like $1.
Nice. Okay.
But if you haven't been recently, Kingpin at Crown is just a complete shambles.
Oh, really?
There's people everywhere. There's definitely no COVID safe practices there. Like you're putting on VR goggles. And my eldest now, he loves VR games. Puts on the goggles and you're smashing stuff in front of you and pushing stuff out of the way.
Does he get disorientated as to where he is?
I don't know.
Like in the... Yeah, like... I presume you can smash stuff in a certain direction, but if you spun around...
You're sitting in like a machine.
Yep.
And so you're fixed.
Right.
Also, although there are different machines where you kind of can start walking around a little bit, but they've got a perimeter around it. And it was really good value. Most games are like $2 or $3 a pop. And that's where the kids are playing Halo on your reference the other week.
What'd they think?
It's
just a shoot.
Julius loved it.
How cool is it?
Yeah, he loved it. But I was just shooting NBA hoops, like just trying to beat the previous person's record. It's like you hit 56. I'm just going to keep playing until I beat your score. And I don't even know who that person is, right? All right, we'll wrap up. Check us out on YouTube. If you've got questions, info at baharianwealth.com.au, and see you next week.
Perfect. Cheers, guys.
What the hell is this? The Snap up 60%.
Yeah.
What?
Oh, yeah, well, they're up 54% after hours. I mean, it was mental. Yeah, they went from 24.50 and they closed at 30.
So it's down 30% before earnings, and then up 60%. What the hell?